Picture this: you log into your investment account, ready to check on a nest egg you have held for years. You believe you own 2,500 shares of SpaceX through a specialist vehicle. At current private market valuations, that position is worth over $300,000. But when you try to cash in, the shares are simply gone. Even worse, you discover your own investment firm sold them in 2024, without a single notification, for just $45,450. That is not a hypothetical. It is exactly what happened to an investor named Rupireddy, and the news broke across finance headlines today, the 9th of August 2026. The gap between $300,000 and $45,000 tells you instantly that something deeply wrong has occurred, and it exposes a fault line running through the opaque world of pre-IPO share dealing. According to reports by Yahoo Finance and others today, Mr. Rupireddy did not hold direct SpaceX shares. Instead, he owned a stake in a special purpose vehicle, or SPV, which the investment firm Late Stage Management said held the underlying stock. In 2024, Late Stage Management apparently sold the shares inside that vehicle at a total value of $45,450. Yet at the private trading price of roughly $120 per share, his 2,500 shares should have fetched around $300,000. The crucial failure was communication. Rupireddy says he never received any notice of the sale. Without an alert, he had no chance to object, to find a different exit, or even to understand the true value being destroyed. This is not a story of a bad market timing. It is a story about an intermediary acting unilaterally in the shadows, and that distinction is what makes it legally and ethically explosive. Rupireddy is not an isolated case. Several news outlets report that dozens of investors are now taking coordinated legal action. The common thread is that shares they thought were safe in an SPV were liquidated without their knowledge. The wider impact is immediate. Confidence in private share custodians has been shaken. Anyone holding pre-IPO stock through a fund or vehicle must now question whether their ownership is genuine or simply a paper promise. The root cause is the tangled structure often used to bypass the fact that private companies like SpaceX do not offer ordinary share trading. When you buy into an SPV, you are trusting the manager to hold and eventually distribute the asset. If that manager decides to sell without telling you, your legal recourse is far murkier than if you held shares in a standard brokerage account. Today's revelations are forcing that risk into the open. Looking ahead, the legal battle will likely focus on whether Late Stage Management breached its fiduciary duty and securities regulations. If courts find that investors were intentionally kept in the dark, the penalties could set a new precedent for how SPV managers must operate. More broadly, regulators in both London and New York have been scrutinizing the pre-IPO marketplace for some time. This case lands at a moment of heightened awareness about retail access to private unicorns. We can expect fresh calls for mandatory real-time reporting of SPV disposals and perhaps a regulatory requirement that underlying share sales cannot proceed without explicit investor consent. In the near term, funding into SPV-based platforms may cool as due diligence demands rise sharply. So what is the takeaway if you are sitting at home, perhaps holding your own private shares in a hot company like SpaceX? First, verify the precise legal structure. Ask whether you own a direct beneficial interest or merely a contractual claim through a special purpose vehicle. Second, demand regular, auditable communication on any liquidity events. If your platform cannot guarantee notice before a sale, you are carrying an invisible risk that could wipe out most of your value overnight. Rupireddy's experience is extreme but not unique. A missing notification turned a $300,000 dream into a $45,000 lesson. In the fast-moving world of private equity, transparency is not a luxury. It is the only thing standing between you and a sudden, silent loss.